Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
G'day Equity Mates, well welcome back to another episode where we are following our journey of investing, and whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. Now, if you have joined us for the very first time, a massive welcome. Welcome to the Equity Mates community. Welcome to the start of your investing journey. We do have another podcast, Get Started Investing, to get you up to speed if you're still feeling a little overwhelmed. Now, we are licensed, but we're not aware of your financial circumstances, so any information on this show is for entertainment and education purposes only. Any advice is general. With that said, my name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Great to be here for this episode. We are trying something a little bit different this episode, getting a little vulnerable, sharing our deepest fears, stresses, you are. So we will get to that. And then we've also got a few questions from the Equity Mates community. But before then, Bryce, a reminder for everyone that we are in the final days of our Equity Mates merch sale.
Yes.
We've got 4 shirts to choose from, some crackers. We've got the black shirt with the Equity Mates logo that you and I are both wearing now. We've got a white version with an embroidered logo, very high quality. And then we've got 2 more shirts, one with the OG Equity Mates logo. If you've been listening for a long time, since 2017, you may remember it. It's you and I riding the Wall Street Bull. And then finally, we have the FinFest Unicorn shirt as well. If you loved FinFest last year, if you can't wait for it this year, you don't want to miss out on that one. equitymates.com/shop. Sale ends this week.
Love it. They are running out the door. Now, Ren, as you mentioned, a bit of a different format for the first half of this episode. We are excited to sit down with Maddy from You're in Good Company, one of the shows in the Equity Mates Media Network. They're doing an awesome job. In fact, their most recent episodes have been interviewing some of Australia's leading founders. Their most recent episode was with Laura Henshaw. So if you want to go and check that out, please do.
And you're going to want to be subscribed to that feed because they have maybe the biggest guest in Equity Mates history across any of our shows coming up in a couple of weeks.
Yeah, with not embellishing this, but they are one of the world's biggest, most recognised investors.
Yeah.
It's phenomenal effort that they've been able to secure this investor. So make sure you're subscribed to Your Own Good Company. But we're joined by Maddy, who challenged us to the idea of sitting down and trying to emulate the format on one of Australia's leading podcasts at the moment, The Imperfect. A podcast that I hadn't listened to leading into this, Ren, which you had. So I was a bit nervous about what was to come.
Well, I am very excited for today because even though I set you guys some homework, only one of you completed it by listening to the Imperfects in advance. So Bryce is going in. Bryce is coming in pretty blind to this episode. But for those of you who don't know what the Imperfects is, it is a podcast hosted by Hugh Van Cuylenberg, the founder of the Resilience Project, his brother Josh Van Cuylenberg, and Ryan Shelton. And basically, they interview guests who are willing to make themselves vulnerable by sharing their imperfections. So the way each episode works is that the guests enter what is called the Vulnerabilitea house, and they are presented with 3 cards or prompts, and they have to pick one to answer. So we did this a few months ago on YIGC, and it was one of our favourite episodes to date. So today we are going to pay homage to the Imperfects with an investing twist and do an investing version of their podcast. So I'm going to give each of you 3 money-related prompts. Who wants to go first?
You go first.
I'll go first.
Yeah.
Okay. Any questions before we start?
Are we getting the same prompts?
No.
Oh, okay. And so the rules of the game for people who haven't listened to this podcast, like Bryce, you get 3 questions and you answer one of them.
Correct.
Okay, cool. I get to choose which one.
And you get to choose it. You get to choose which one. So I'm going to pop the 3 questions into a doc now, and I want you to read them out. I want you to tell us what you're thinking. Like, speak
I'm
out
kinda
loud your
nervous.
thoughts.
Where's this doc?
Yeah, where's the doc?
I'm sharing it with you now. Bit of patience.
So these are all money-related questions.
They are loosely.
Loose.
Loosely.
All right, doc is
How much
through.
money do you have?
My heart's kind of racing a little bit.
I wish I did. How much money do you have? That would have been a good one.
I don't know what. Okay, the 3 questions are: what is stressing you out financially right now? Nice. Is it your
See, I
responsibility?
did have to say live react. What kind of a live react is that? Nice.
I know exactly what you're going to say.
What?
Oh, well, let's keep going.
Yeah.
Is it your responsibility to be a good financial role model to who? Anyone?
Yeah.
Okay. That's too deep.
That's the point of this.
As the leader of Equity Mates,
Yeah, I know.
you-
That's what I was thinking. I was like, okay. Who or what is currently influencing the way you think about money? Okay. I think for that one, I think I'll go. It's because it's most front of mind. It is the what is stressing you out financially right now.
Great.
Yeah.
Let's get into it.
Okay.
What's on your mind?
We are in the process of trying to buy a house, and that's been something that has been a goal for a while. We being Harriet, my wife, and I, we got married in October last year.
Congratulations.
Thank you very much.
Must have missed the invite in the mail.
Yes, still in the mail. And, we've spent a lot of time talking on the show about growing wealth through the stock market, and I've probably got more of a grasp on that than Harriet does. And I think, for her, the goal has always been a house. And we live in Sydney, and the price of housing is incredibly expensive. And so I think at a high level, thinking about the commitment that a mortgage brings, coupled with running a business, is stressful, I think. And what I mean by that is I would feel much more comfortable committing to a mortgage if I was in a corporate strategy job at Woolworths.
All right. First of all, I'm glad that you're not saying that you are stressed about the business Equity Mates going under financially. So that's a big tick from my perspective. You look guilty, but anyway, we'll move on. Do you think that your current
It's funny you say that, actually. That actually does stress me out.
That's
But
kind of
think
what I thought you might say,
But
to
it's
be
a
honest.
it's a different stress, if that makes sense.
Why?
I don't know. It's a stress that is it's more like I know we can get through it kind of thing.
Yeah.
If that makes sense. Like I know there are options, but the stress of having like my wife involved in a decision that is tied, I think it's, for some reason it's different with having her involved in that, if that makes sense. And like making a commitment to a mortgage that if we then go bust, it's kind of like, shit. Do you know what I mean?
Yeah, I know exactly what you mean.
Yeah.
I mean, the rational side of my brain says you would be unemployed for weeks, like at most. Like Woolies would have you back in a heartbeat. Everyone we work with would hire you. So like there's really no risk. But it's scary.
Yeah. I also think it's the unknown of like what it actually, I think when we were going through the process of buying going through the process of like getting pre-approval and those sorts of things, one of the mortgage brokers was like, everyone can put numbers in a spreadsheet and think that, you can afford X, Y, and Z, but until that actually starts coming out of your bank account and you're like, holy shit, this is it for 30 years. And that readjustment of like, that's literally, I'm not going to be able to get that back. It's there for 30 years. It was like we talk about not paper trading because it's not until you're in it that you understand how it feels. And unless you like do a practice run of like, let's pretend we have a mortgage and start like farming money to just a random account to be like.
Isn't that renting?
If mortgage was the cost of rent, we'd be cheering.
Do you think, is it the sense of being tied down by the mortgage, or is it the sense of not being able to afford it that makes you fearful?
I think this is just, I think it's like a combination of wanting to stretch yourself enough that you get a place that you're not going to want to, that in 3 years you're not going to be like, we need to sell.
Yeah.
And then knowing, and then that, which is fine. I get the idea of stretching yourself now if you are in like a job and a corporate job where you can see a path of pay rises and promotions. And it's like, okay, I know that if I just commit myself here for 10 years or 5 years or whatever, I'm likely to get an increase in pay. So I can stretch myself now. We don't have that certainty to be like in a year, in 2 years, Ren and I are going to be giving ourselves pay bumps. It could be we are cutting our pay so this thing doesn't go under. And so that commitment is what's scary. It's like, what is the right thing to do right now that is the nice mix of right place, right amount of money going out, you know, all of that sort of stuff.
Yeah, it's the biggest financial commitment anyone makes. Buying their first house, up to that point, no one's had anything that big. Yeah.
And then, like, it's also like we are both getting help from Bank of Mum and Dad, which is like, it is what it is, and very, very fortunate to be in that position. If I wasn't, if I was still single, I reckon I wouldn't be even thinking about a house right now, if that makes sense. Like, yeah, just be stress-free. I'd just be pouring money into the stock market.
Not financial advice. How much do you think the rising interest rate environment has affected or not affected how you're feeling at the moment?
Yeah, I've thought about this. I reckon it's a blessing. Yeah, I think that it if we were looking for a house 2 years ago and had the means to do what we do now, I reckon we'd be way more bullish on extending ourselves, way more bullish. We'd be like, yeah, we can afford that. Interest rates so low. RBA saying we're all sweet for 2 years. And probably would have way overextended ourselves and probably got into a fair bit of trouble, because you'd be looking at 1%. The difference between 1% and 5%, we all know, is massive. It's massive.
Yeah.
And so I think it's a blessing to be like, it does happen, i.e. interest rates do go up and can go up quickly. And I think that's something I'll always now have in any big financial decision over my life. It's kind of like, that was a defining kind of moment. And it's like, okay, the advantage of being at kind of the top of a rate cycle, fingers crossed, over the next 20 years or so, you would imagine we would benefit from that rate cycle, hopefully going down again.
Yeah.
Fingers crossed.
I don't know about that, bro.
But you know what I mean.
I don't think we're going from 3.5 back to 1.
We won't go back to 1, no. But 3.5 is cash rate. Mortgage rates at the moment are 5.5.
Yeah.
So like, I think it's a blessing, to be honest, in that it's made us much more conservative with what we probably would have been.
So you mentioned that you had gone through the pre-approval process. If you don't mind sharing, where are you at with it now? How are you feeling about it?
Right now, we actually checked out a place last night that was great. Well, not last night. When was it?
That's why you had to leave our meeting early.
So much for mother-in-law.
No, that was her birthday, the night before.
That's right.
Yeah, night before. And Harriet and my in-laws went and checked it out again today. So we have pre-approval. We've checked out a number of places. This is probably the closest we've been to finding a place. But it has a massive development site right next to it that is like, has been a development site for 10 years and hasn't moved from that.
So, day you get the keys.
Day we get the keys,
So
the bulldozer.
great,
Day we
could
get
be
the
a
keys,
disaster.
the bulldozer rolls in.
Yeah.
It's just like that for me is just one. It's like what is the risk that we're willing to take on that? Because it's the biggest financial decision that we're likely to make. And God, I will be freaking angry if in a year's time the development sign goes up and you're like,
Is that going to be a constant stressor if you buy it? And then every day you're like,
Every day.
is it going to be today?
I know.
It's today the day.
Yeah. Well, I mean, the ideal scenario here, and what I keep telling Harriet, is that in 5 years, Equity Mates is going to be absolutely cruising we may exit.
Any potential buyers are tuning in.
We'll move on.
And then we'll be able to afford the 3 houses next door as well. Well, yeah.
You'll buy the development
But
site.
yeah, the pre-approval process was an interesting one. I think it was eye-opening to see how it happens and how the number that you're given is not actually the number that you can afford. And I think it's bullshit. They just go, okay, what's your combined income? Roughly times that by 5. Subtract if you've got HEX debt, if you've got credit cards or whatever. Okay, your capacity is X. But then if you plug that into how much are my repayments on a mortgage going to be, it's like way out of our league of being able to repay it. And so it's like, why in the first instance is the mortgage brokers even giving you the idea that you can afford this as your capacity? It's just not your capacity. So then you can see how people get into a position of going, hell yeah, we got this.
Yeah.
Let's go out.
It's a funny one. Like you unpick that and there's a few layers to it because you're like, well, why are the mortgage brokers giving you that number? But then like, why are the banks lending it to you?
Yeah. Well, the mortgage brokers give you that number because their incentive is to give you the biggest loan possible.
Yeah, because they get a commission.
They get a commission on the loan for the entirety of the loan.
And if you can't afford it, then you probably have to refinance it at some point.
Yeah, exactly. And I know the banks do their due diligence so the mortgage broker goes, yep, they then go to the bank at the time of the purchase. I think they then re-look at your finances, but nothing's going to change between 2 months ago when we got it and now. And so it's on us to get the spreadsheet out and be like, what can we actually afford here, combined with our expenses, combined with what might happen over the next 5 years in our lives.
Yeah, equity mates go bust. You have a kid.
Yeah, do we have the emergency fund?
Yeah.
What happens if Harriet takes a year off for maternity leave? If I then have a mortgage, can I handle that mortgage? Like, that's not discussed with you with a mortgage broker. They just go, here's your money. Let us know when you find a place. So it's like, it's kind of bullshit.
Yeah, it's a bit concerning, isn't it?
It's almost as if personal financial advice should be accessible and affordable.
Yeah. So all of those things combine to, I think, a super exciting experience, but one that is like, brings a level of stress.
And I've just got to say, I am outraged that we're not making content about it.
What, my property journey?
Yeah.
We just did.
Stay tuned.
So yeah, that's what's stressing me. And it's funny. Were you going to say that did you think I was going to do Equity Mates?
No, I knew you were going to do house.
Because the running joke is every month I tell Ren how stressed I am that Equity Mates is going to run out of money.
The amount of times
I
he's
feel like
told
I've
me.
heard you say that. Mate.
He's the boy that cried wolf.
I still remember I was up in Sydney a few months ago working in the office one day and the power went off and we thought like someone, do you remember that? And someone came round and we were like, have we run out of money?
Just to be clear for those that are listening, we are okay.
Well, no.
That was just me doing cost-cutting measures.
For anyone listening, if you would like to sponsor us to keep our lights on, Bryce at equitymates.com.
Yeah.
Love it.
Yeah. I think the stress with that obviously comes that we have 8 people working for us. That's the stress. Yeah. And that is one that I do. I think it's been such a consistent level of stress that it's now normal. You know what I mean?
That's the baseline.
That's the baseline, yeah.
All right. Ren, can you please read aloud your 3 prompts?
Sure. What's one money mistake you keep making? What's the...
Live reaction.
Darcy's social media, he's going to be like...
What's the biggest financial epiphany you've ever had? And then if you could make an investment with no financial risk, what would it be and why?
All right.
Part of me wants to do a Hamish Blake and answer all 3. I think... What's one money mistake you keep on making? What's the biggest financial epiphany you've ever had? If you could make an investment with no financial risk, what would it be and why? I think the answer to the last one is a little bit obvious, so I'll just say it, but then I'll answer the second one.
Great.
make an investment with no financial risk, the speckiest of micro caps and make some money, or Equity Mates. If I knew that Equity Mates wasn't going to fail, what would I do?
Can we unpack that?
Sure. I don't know. Probably not work as hard.
Right.
Yeah.
Maybe along then.
I mean, what would you do if you knew we weren't going to fail?
Like, does that mean we have unlimited capital?
No, it just means everything's going to be okay.
Oh, everything's going to be okay. Oh, well, we'd definitely be doing FinFest 2023.
Yeah, true.
In full pelt.
I would be so hard on ad
AFL
spots.
podcast.
I'd do an AFL podcast for sure. But like one ad spot.
I think what we'd do, is there'd just be way less focus on commercializing content.
Yeah.
And we'd probably be truly following the content that we just want to do every single episode. Yeah.
Oh, we would have like 20-minute long intros and we'd just be chatting as well. Like all of the like the media lessons that we've learned over the years would just throw out the door.
Out the window.
Yeah, and probably expand overseas somehow. Go overseas and try and expand overseas.
Yeah, Equity Mates Indonesia.
Yeah, Equity Mates Indonesia.
Yeah.
Anyway,
Good question.
it's actually the one you're actually going to pick.
Biggest financial epiphany I've ever had. The first financial epiphany I had was when I was living with Bryce and I was introduced to the stock market. That was, in hindsight, a big sort of turning point for me. Learning about this whole world, the opportunity there, getting my head around just how big an opportunity it is compared to other ways to build wealth as a near broke uni student.
So can you take us back? How old were you? Where were you living? Paint the picture.
How old? I would have been 24, 23?
When we met?
No, when we lived. So we met when I was 18. But we weren't
uni?
really, we weren't really talking about stocks while we were at college.
No.
Yeah.
Definitely weren't.
Yeah. It was, and then when we lived together, it would have been like 22.
Yeah.
23. And I don't know how it started.
Me either.
Yeah.
Were you in Melbourne?
Canberra. Yeah. So that was the first, but I think the biggest has been this idea that no one in the financial community, no one in financial media really talks about this idea of enough. What is doing enough as a young person? How much do we need to invest to live the life that we want? And I think it's a product of so much of financial media comes out of the institutional world. And there's no such thing as enough in the institutional world. Like, your job is to make the extra basis point, beat the index by more and more. And like, if you can get more, you take more. And then like in that world, in the world of high net wealth and stuff like that, like money, yearly returns, all of that eventually just becomes a way to keep score. And it's a little bit divorced from like why we actually need to invest and why everyone should be investing. And I'm sure if I had a financial advisor, there would be a lot more conversation around like, here's what you need to do. You can be confident that you're doing enough. Go and live your life. But that just doesn't really come through it didn't really come through in financial media, but it should, because I think that more than anything turns so many people off investing. Investing looks like this like deep, cavernous rabbit hole that you just have to jump in head first and like keep falling down, and it becomes all consuming. Whereas really it's the shallowest of pools that you can just dip your toe in and then keep walking.
So as someone who has now built a business in the financial media space and who I guess is trying to create an alternative to the traditional finance media out there, have you figured out what is enough?
So I think there's a few different answers to this question. I think the simplest answer is a number of retirement organizations around the world quantify how much money you need in retirement. And so enough is just taking the market's average return. How much do I need to invest today to get there by the time I want to retire? These days, I can't recall the numbers off the top of my head, but you're looking at like 1.5 million is kind of like today what a good number is if you own your own home to live a comfortable retirement in your super account or your pension account or your 401k in the US. And so then you just work back from there and you say markets average 8% a year over the long term, and what does that look like? And the number becomes pretty manageable. Like if you're investing a couple $100 a month, if you're in your 20s and you're investing a couple $100 a month in a index fund, you're doing enough. And then like over time you'll earn more, you can invest more, but just be confident that doing that now, live your life, financial life, confident that you're setting yourself up for retirement. So yeah, I don't know if that's a real epiphany, but I think it's just something that I felt was lacking from the way that I thought about money. And now for me, everything that I do outside of that, because I still invest in individual stocks and I still want to make that extra basis point and, you know, I still want to do all those things. But for me, it's like I now think of that as that's more than enough. And I've done the enough part of it.
I think one part of that fact around the number for retirement that I always find really interesting is that point around if you own your own home, because that, I think, correct me if I'm wrong, is taking into account or assuming that you've paid off your mortgage by this point. Yeah. So you're essentially not paying rent or a mortgage in any way possible. And I just wonder whether, you know, in the past that's been quite a realistic expectation, probably fair to say, in previous generations, but I wonder if it will be the same more broadly for our generation.
We've got a lot of content around this. We've got a book on this concept coming out later this year. And so when we were researching it, it is universal. It's not just an Australian thing that the like the retirement planners and the organisations and associations all say, if you own your own home, this is how much you need. It's across all Western countries. It's just assumed. Mainland Europe is probably the example where like there's much more of a renting culture, and honestly I couldn't tell you what the numbers are in Germany and stuff like that. But yeah, I don't know what it would look like, because the number would blow out, you would think. Yeah. I love being curious and building things and working. So for me, it's like I'm more than happy to work up into the retirement age, and I'm pretty confident that I'm going to keep working well past the retirement age. So I don't have a number where I'm like, just 30 more years. I'll get to 60 and I'll be able to call it. So I'm not super worried about that. Again, back to this concept of enough. For me, it's like I would love to get to that point as soon as possible, just so it's like stress is off the table.
Yeah.
But I'm also very mindful to Bryce's earlier point that I'm in this like golden period now where I'm not married, I don't have kids, and I don't have a mortgage. And so it's like it's on me right now to make the most of this time and invest as much as possible, because very quickly that money is going to go elsewhere.
So you touched on how at this stage in your life you're child-free, you've got the ability to, you know, really try and invest, I guess, in your future self. How do you balance that with this notion of like being young, being in your 20s or 30s and wanting to make the most of these years and really like live your life, whether it be travel or spending time with friends?
It doesn't cost a lot of money to spend time with friends to start with.
This is true.
But I think it's a good question. People often paint it as a dichotomy. It's like I have to either I can have fun now and have no money, or I can get serious with money and then not have any fun now and hopefully have fun later. I don't think it's a dichotomy. I think if I look back on my life, when I was the loosest with money, I didn't have the means to do anything. I was just, for me, getting serious or like learning about investing, understanding the value of a dollar has meant that I've had more money to do things that I want to do now, like travel and stuff like that. And it's also just a product of, as we get older, we make more money, and so it feels like that a little bit. But I think it's like if you get serious and you pay attention to your money, it's not like it's all going to go to investing. It's also going to go to that travel savings account. It's also, going to go to that Bryce's house deposit account that he's built up. It's an enabler for everything that you want to do. It's an enabler for the life you want to live in the future, but it's also an enabler for the fun you want to have now. And I think, so for me, it's not like it's a false dichotomy. It's the choice is actually between just being loose with your money and not being able to do anything now and in the future, or being intentional with your money and being able to do more now and more in the future.
Makes sense. Thank you both for your vulnerability and for embracing today's episode. I do want to end with one quick fire question for each of you, and it is, I would like it to be quick. What is your top money green flag and what is your top money red flag? Straight off the top of your head.
Like in a relationship?
Sure.
Is that the idea?
Yeah, let's do that. That's fun.
Mine fits both.
Okay.
Discipline.
How is that?
Green
Explain.
flag. Discipline. Green flag.
Undisciplined.
No discipline. Red flag.
Great.
Yeah, I don't want to just copy Bryce. Like, we're very similar, but I feel like it's like overall vibe towards money.
Yeah, I get that.
Yeah. I know. I think,
Like an appreciation.
yeah, and just like, like
Likes nice things.
have you got your shit together? Do you
Yeah,
wait? Like, how do you think about money? Do you think about money? But honestly, like, it's not a. I think I think about money enough for multiple people. Like, I don't know. Like,
You
we
got
do it
everyone
for a
covered.
job. We speak about it all the time. Like, for me, a relationship isn't made or broken by that.
Nice.
I don't know.
I think from a relationship point of view, if it's something that you've got to be on the same page with before there's any level of commitment.
I think now that I've said that, I actually probably disagree with myself. I just probably
It's not about vibes.
no about it doesn't make or break it.
Yeah. Thanks, guys.
All right, Bryce. Well, that was certainly different.
Yeah, I enjoyed that. I think it was good. And I think we should say that if you're listening at home and interested in contributing a question, this is something I think that we will weave into the format of Equity Mates over time.
Yeah,
So-
well, I think we'll do the segment again.
Yeah.
certainly.
So hit us up at contact@equitymates.com, and our producer, Sasha, will make sure that any of your questions finance related, or are we opening up? Let's go finance related.
Well, I think we can't open it up too much because
then
then we're
you just-
ripping the imperfects off
know.
more than we already are.
Yeah, so let's just keep it finance related. But yeah, that was good. I did enjoy it.
Yeah.
bit of a different segment.
Well, Bryce, let's take a quick break. And then after the break, we're going to talk about the do's and don'ts in investing in companies that are being acquired or doing some acquiring, and also explain how the pricing of ETFs works.
Who you gonna call?
Hello, your call has been forwarded to an automatic voice message system. Leave your question after the tone and Equity Mates will answer it.
Hey, Equity Mates. Try and keep pretty.
Hey, Equity Mates. I've heard you guys talk about this before.
Hey, Equity Mates.
But I'm always
So
forgetting.
I got pretty excited when I first
Hey, Equity
started
Mates.
investing.
You're always talking about investing globally. Do I have to?
It's the Equity Mates listener mailbag. Visit equitymates.com/contact us and leave us a voice message, and we might be answering your question on a future episode.
All right, Bryce, well, we're back and we've got some listener questions that we're going to answer for the rest of this episode. As we get more professional as podcasters, we've also got segment openers.
All right, so we've got a couple of questions here from the community to get stuck into. First one is from Riley.
G'day, Equity Mates. Riley here. Recently, I found your podcast and have really enjoyed your 12 steps to get started investing and your Get Started Investing series. I've yet to start my investing journey, but I'm really close thanks to you guys. My question is, if there are rumors of a company being bought or sold, is it a good idea to be purchasing stocks from that company, or would it be better to invest in the company that is making the purchase? Alternatively, what happens if you own stocks from a company that has just been brought out? Thanks, guys.
Nice. Thanks, Riley. And congrats on getting through the 12 episodes and almost starting your investing journey. Some big questions there for someone who's just kicking into the market, but some valid questions. And I think my first overall answer, Ren, is don't try and play the market based on rumors.
Okay.
Silly thing to do. I can understand where this comes from, though. Like, you'll often see a rumor of a company being bought and then that company's share price absolutely run up. and you can see the temptation of trying to be involved in that. But my point of view is it's a fraught game to try and be buying companies based on rumor, and you'll often find that your information flow is not the first person to find that rumor. So any sort of share price has been sort of baked in, and you're going to miss any massive run up, if that makes sense.
Yeah, well, I think you've covered rumors, but I think there's a bigger question around just when it's not a rumor anymore. When it's been announced to the market that an acquisition's happening, how do you invest? Or if you own stocks, how should you manage it? And there's a whole world of investing and a whole investing strategy called merger arbitrage. And basically what that style of investing says is when an announcement is no longer, when an acquisition is no longer a rumor, when it's, it's in play, and Equity Mates has said they're going to acquire Commonwealth Bank for $100 a share, the Commonwealth Bank share price will run up and it will get close to $100, but not quite there. And as the deal gets more and more certain, as it gets regulatory approval, as Equity Mates gets its financing in order and the Commonwealth Bank shareholders vote for the takeover, the share price will get closer and closer to $100. And that indicates the increased likelihood that the deal goes through. And so there's a whole world of investing, and there's a whole, there's heaps of content we could do on it. But if that is something that you're interested in, that is a rabbit hole you can go down. Not something you need to worry about, especially as a new investor. So I think if you own shares in a company that's getting acquired, it's much of a muchness. You could sell it before the acquisition happens and get most of that money back, or you could hold right until the company's acquired and then get shares in the acquirer company or get your money back, get your money. I generally have just held, like we owned Slack back in the day and it got acquired by Salesforce, and I got shares in Salesforce.
After paying Block.
Did you get, hold on, with Slack, did you hold and do you have Salesforce? I
didn't buy Slack.
Didn't you after HM1?
No.
Remember when TDM pitched it?
No, I didn't buy it.
Oh, okay.
No.
You tricked me.
I don't think I didn't.
Okay, well, Afterpay and Block, what did you do? When you owned Afterpay and then Block?
Sold Afterpay.
You sold Afterpay? Yeah. Didn't want Block?
Didn't want Block. And it was also I sold Afterpay. After the news of the acquisition, obviously.
Yeah.
Yeah.
So that's if you own shares in a company that's being acquired. And then just if a company is acquiring, like if you owned Block in that example and it was acquiring Afterpay, I don't think the only reason you should do something is if it changes your investment thesis. But if you invested in Block because you believed that digital payments are going to take over the US and that their Square operating system is like a great solution for small and medium-sized businesses, your investment thesis doesn't change if they buy Afterpay. So in that case, you don't have to do anything. Yeah. So a few aspects to it.
Yeah.
Long and the short of it is you don't have to do anything. A lot of investing, you just don't have to do anything.
No.
Let your companies go to work.
Yeah. Just buy for the long term.
Yeah.
Let them chill out. Nice. Well, thanks, Riley. Keep the questions coming. Our second question is from Bailey.
G'day, guys. So I've just read the ETF section of your book, and I'm looking at investing in Australia's top companies. Now, I'm looking at the VAS from Vanguard, which is the top 300 companies, a management fee of 0.1% currently, and around $90 trading. But I've also looked at Better Shares, which is the top 200 companies. It only has a management fee of 0.04%, but it's at $120. So I'm a little unsure why there's such a big price difference. Obviously, we want the lower fees, but I'm just stuck which way to go.
Nice. Thanks, Bailey. This is something that does confuse a lot of people when they first start investing in ETFs and comparing ETFs. They're comparing the price of ETFs is not the way to compare ETFs.
And why that is because the starting price of an ETF is highly arbitrary.
Yeah, it is just set.
The ETF provider says, we're launching an ETF and the units are going to be priced at this. And so if you look at Vanguard Australia, one of the two ETFs that Bailey just spoke about, you can see that its starting price back in 2009 was $50 a unit. And BetaShares A200, when they listed that in 2018, they started at $100 a unit.
Yeah.
And so those two starting prices were the starting prices, and then over time, the ETF has moved with the Australian market, but that's why the price is different.
Yeah. So it is no indication of one performing better than the other. Don't use price as a comparison. The two other things that you mentioned there, Bailey, around management fee and underlying holdings is actually the more important things to be thinking about. And the clear difference between the two, as you already noted, was VAS is top 300 companies, so it's Australian shares. And the BetaShares is A200, the ASX 200, so the top 200 shares. So it's actually got different underlying holdings and is going to be, based on that, have different performance.
Yeah.
So the question you really need to answer, Bailey, is do I want exposure to the top 300 or the top 200? And that will probably guide this decision more than one is priced at $90 and one is $120. Which should I be going?
Management fee was the other thing you mentioned there, and you know both of their management fees are incredibly low. BetaShares is the lowest in the market. Someone came for that crown and cut their fees, and then BetaShares cut even further to maintain the lowest. Realistically, it is a basis point or two. So you're not making a bad decision with either one. What's probably going to drive the performance more is what you were speaking about, Bryce. The A200 has more of the big companies, more of BHP, more of CSL, more of Commonwealth Bank, because it's a little bit more concentrated, whereas Vanguard's 300 will give you access to some of the smaller and potentially up-and-coming companies in tiny percentages of the ETF. But, you know, maybe you get a bit of their growth a little bit earlier, but tiny, tiny percentages. They're very similar ETFs.
They are.
You're not going to make a bad decision choosing between these two ETFs. I think that's a fair comment.
Yeah.
There's no bad decision here.
No.
And I think that's the confusing thing when it comes to investing is like it is so hard to... You're putting your own money on the line and it's so confusing. There's so much jargon. There's so much unknowns. But like just be confident that though you've identified two good ETFs to build a core portfolio around.
So a massive thanks to Riley and Bailey both for submitting your questions. Keep them coming. Head to equitymates.com/contact to leave a voice message, or if we can't get to it, there are plenty of people in the Facebook community who are able to help along your investing journey. So head to the Facebook group if you're not already a member. But Ren, that does bring us to the end. We've got Ask an Advisor coming up this Thursday with one of our good friends and very quality financial planner and advisor, Jacob. We're getting him in to answer some questions around how he'd invest $10,000, whether or not you should pay off HEX faster now that the indexation is up. And he shares some of the strategies he's seen some of his wealthiest clients put in place. So that drops on Thursday. Super excited to continue our Ask an Advisor series. But Ren, as always, absolute pleasure. We'll pick it up next week.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.